Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. Wait, where's the music? Where's the music? Hey. Non-farms today. It seems like every non-farms this cycle has seemed important. And of course, how important it will be will very much depend on the ultimate number. But seeing as how the market thinks that we are getting the end of the cycle here and that the Federal Reserve is going to pivot and so forth, that makes this particular non-farms set up to be just a particularly crazy one. That, and we had such a big beat last time. This is going to kind of set the record straight on where we're actually at. If this non-farms ends up being higher than anticipated, I think the market could throw a real fit here. So let's just go to the charts real quick. Look through them all. Here you can see the Treasury is kind of moving up towards where we were at yesterday. That whole move reversed yesterday. That was a really wild reversal day. I haven't seen a reversal day like that in a long time. Oil bullish from yesterday. Gold and silver got at the bottom of their range, trucking along. Copper taking a little bit of a hit this morning, but still within its range. Bitcoin giving up a lot of the gains that they had over the past days, and the dollar towards the bottom of its range at 105.6. 105.6. Yeah. So if the numbers are bad, yeah, totally could. Like if we get another non-farms like last month, then equities will get destroyed here for sure. I think. Did I get destroyed yesterday? Oh, I was short equities. Oh my gosh. Yeah, I wouldn't think that would work out too well. But I mean, so here's the issue. Just to let you know, the balance of flows, the way that the CTAs are positioned, the way that things go into the end of the year overall and so forth, is all long. Okay, so if these non-farm numbers are like really close to where they're supposed to be, I would anticipate that the equity market, at the very least, continues to move up. The treasury market, I'm not so sure about. I think I've gotten my beard about as long as I would like it to be. Today I think I will trim it back a little bit. I have a lot of thoughts. I was just reading a thread about fair value gaps, and I was, like, how do you define a quote-unquote reaction? And I had a couple of thoughts about, well, maybe we could do this study and show these things, like how likely is a certain price to be revisited within a certain time frame compared to like just random chance. How much volume is there when it returns, that sort of a thing. Like, can you define that there actually is a quote reaction? Man, okay, so the S&P 500 just had somebody hit into it with a sweeper and really upset the liquidity there. this, and you look at the liquidity in the treasury market, pulled well before the news. The market is anticipating this to be a very consequential number. But again, all depends. Non-farm payroll is 180. I think that we would probably be okay up till like 220, but like if we got like a 250, that'd be super, super bad, right? And I do think that there's a chance that it will be higher than the 180, but let's see. If it's lower than the 180, then everybody's going to be like, what? What's going on here? That will really make people question the efficacy of this number, right? It was 350 before, and now it's like 150. What? Okay, here we go. They're rising. 150. Oh my gosh. Oh, that's so funny. Exactly the number that I was speculating on there. Not that I was calling it was going to be 150, but I was like, that would be like the most confusing number that we could get is 150. Yeah. Oh, and they buy that. Oh, they're going to buy that for sure. We're already almost touching 43.50 and the treasury yields. Can you believe that we were almost at 5%? Oh my gosh, look at how far we dropped there. Wow. We were at 46.30 before, and now we're at 45.71. So just on the news, 6 basis points decline. That is something else. So 455 is probably a within the cards today. Jeez. That is so wild. Well, I don't even know what... I mean, over here in equities... I don't know about buying this price. I mean, it depends on how big of a wad you have to trade, but I'm going to bet that sometime next week we could see 4,400. Well, now we got to go check the TLT, man, because now those TLT options are almost certainly going to pay out, right? Oh man, maybe they really are the lotto ticket that people were looking at. Maybe I should have done it. Ooh, I get an upgrade for $1. Nothing. I'm pulling up Trading View here. Woulda, coulda, shoulda. I had no clue what the non-farms... this is one of the things that always drives me crazy is that, sometimes being able to predict what's going to happen down in the market really comes down to your ability to predict like one thing. In this instance, like predicting that the non-farms was going to be 150 was like the only thing that mattered, right? Yeah, there's 43.50. Oh man. Okay, so yesterday it was like 87.10. That was kind of like the key point, right? Now they're at 87.92. And I'm not so sure that the treasuries will just give those gains up at this time, right? I think that this is more likely to do like a double distribution. Like they're going to try and find a spot. It might be higher, but it is going to go back and forth and they're going to find a spot. But I don't think it's as likely as yesterday that this completely retraces. Because the non-farms being 150 really strongly supports what we've been seeing in a lot of other data that suggests that the economy is indeed slowing down. And so the scenario where the yields come back a lot sooner than we anticipate may be more likely than the market was thinking it was 5 minutes ago, right? So, geez. Well, in the Treasury, 108 even is one round number that you might see some shenanigans at. So I'm going to try and keep an eye on that one. Now, for the Treasuries, let's see here. I could probably do 10 of those. So if, let's say that they're up 80 cents times 10, you made $800 on it so far. Well, so that's a 1-to-1 risk reward. Would really depend on where they get to within the next week. Would they be able to push a whole lot higher than this in the next week? Because, well, 4-5. I don't know. I don't know. That's a tough one. It kind of goes to show that where those guys were buying the options in TLT really was a stretch. So it looks like the market is going to outperform, but they might not be able to hold that to the expiration. So like if you were in those options, you have like a big decision to make about whether to take the profits on those or not. Ooh, that's almost a more interesting question than the original trade was, isn't it? Because, I mean, it's not out of the question that they could get to like 89 or 90. Well, meanwhile, the dollar just got destroyed there, man. Just destroyed. I guess that really helps the Japanese yen. You know, when I went to bed last night, I was little concerned about the Japanese yen from the things that I was reading, but that's really going to help the Japanese, right? Because they were doing stimulus again. They're like, oh, inflation's so high, let's do stimulus. Why did all the politicians make the same stupid mistake? Is it because that's all they know how to do is spend money? I don't know. By the way, another key point one should make here. Gold at $2,009. So is this when we finally get gold over 2,000 and it holds it? Kind of looking like it. Man. Maybe there's some talented writers out there that are writing all of this stuff, but I would not be able to come up with a storyline this great, man. This stuff is just so... Every turn is you know, ironic and crazy and... Jeez. Let's come over to a volume profile here and try and game out some scenarios, maybe. So we are retracing a good portion of the downside action that we've had since October 19th. So getting close to where we were last non-farms payroll report. But I feel personally that this market, it looks more bullish to me than it was when we were back here at October 8th. Do they have enough volume to get back up to that area? Probably. Today, who knows? But yeah, I think that you could maybe rally all next week. But it depends. Obviously, there's always a number of things to consider. Too many drawing objects when I'm that far out. ZN. Okay, now in ZN, we are getting to some critical points. I think that this was where, wasn't the 12th like the CPI report? So let's see here. 108.16. 108.16 is a key benchmark. If they were to get there, I bet you that you'd probably see a hard bounce at least the first try, but what is the yield curve doing? The yield curve is steepening. Considerably so as well. Well, I don't know if I can make a trade in this monster. Because if we get a pullback, you know, like, it could pull back, you know, at least to 108 even. But so far, the pressure's not letting up. This is a situation where I think you're going to see people scrambling hand over foot to get to FOMO in, right? So we might not get very good pullbacks. I guess I just kind of have to let it do its thing. It's usually not the best trade for me on a Friday. So I'm just hearing on the news squawk, I don't know who it was that was saying this, but they were saying that they expect June to be the first rate cut. Nick Timoros tweets, hiring slows, employers added 150,000 jobs in October and the unemployment rate rose to 3.9. August and September figures revised down a combined 101,000. Yeah. Like, let's just be real now at this point. As far as I'm concerned, the initial non-farms jobless, jobs created number is completely useless right now. It tells you almost nothing about what the final revised number is. I kind of feel like that we should stop, giving it as much precedence as it does, because their methodology is messed up and is just resulting in insane distortions. You get 300,000 one month, and then you only get 150,000 the next month. This is really quite startling. Really quite startling. I think Zero Hedge will have a story now after 10 minutes about what the market thinks. Jobs come crashing down. Oh, they have their Goldman's reaction matrix. What did they say? It was less than 150, then the S&P will rally at least 100 basis points. Well, where are we at right now? 0.47. So according to Goldman, they're only halfway there. According to Goldman's estimate, rather. Nothing about the treasuries, though. I mean, they're still pretty steadily moving up, because the initial stop was 04, so they've been able to get all the way to that, just real slowly. Okay, let's read the Zero Hedge story. With the October jobs report already expected to be a big drop from September's 336K, as a consensus expected a 180K print below the whisper number of 211K, which is kind of what I was thinking it might be. Moments ago, the BLS confirmed that last month's surge was nothing but a Bidenomics mirage, as we warned in our preview. Sorry. The BLS confirmed the last month's surge was nothing but a Bidenomics mirage, as we warned in our preview. The October print indeed came crashing down to earth, sliding to 150K, a drop of more than 50% from the original September print, and the second lowest since 2022. Wow. Look, still going. Still going. I love the smell of fake numbers in the morning. Oh, man. Okay, well, it's been 15 minutes, so this is the point where I need to get over my shock and think about if I'm going to do something or not. I'm absolutely terrified to touch this. I feel like I should be touched. Like, there's so much opportunity. Like, I've got to get in on this, right? But I just can't. Oh my gosh, and the way that it's going too, because like, oh, okay, 455. That's a nice round number I could get in on. Nope, not even. You know what? I think Goldman's reaction matrix might be right. I think that the S&P 500 will end up with a 1% gain on the day. 100 basis points. I'm still a little uncertain about the treasuries here. I mean, I feel like that does bring forward rate cuts. But, you know, the S&P is really going to be happy about this. So, you get this conundrum, right? Well, it's like, it's bad because it shows the economy is slowing, but that means the interest rates will come down, and that means that the equities will push, but then that means that you're going to get inflation, and so then maybe you can't reduce interest rates, right? Like, how does that one actually work out? Nobody knows. How much can the treasuries move here today? You know, we've gotten a very persistent trend. Somebody's definitely buying here. How much can we buy? Well, we started at 70. We're at 107. So we're already at 37,000 contracts long. And once we get into the 30s and 40s, you kind of like start to run out of volume. I don't know. Well, I guess on a non-farms though, I don't think I would necessarily be getting to a point where I'm like, there's no way they can't buy more until we're like to 60, 80. There it goes again. There's another basis point. So we were at 3. So we're about to get to 10 basis points right now. The 30s and 40s you ran out of. Now, how come I ran out in like 20s then? I still got some hair. It's in the back, right? You don't lose hair. It just migrates. See? It just migrates. Down here. Migrates. Deep offer stack. There are a couple of offers up in here that are bigger than anything that you see on the bid. I would say that the liquidity here looks fairly typical at the moment. I guess the thing that I find odd about the liquidity right now, and this kind of goes off of the discussion that we were having with Lucas and I was actually having with him last night as well, is that we are getting an incredibly one-sided market, and I'm not really seeing the market makers react to it accordingly. I find that a little odd, don't you? In fact, 5K at 13 is a little bit wowzer. Like, if you're taking profits, then sure. But, like, who in their right mind would take on inventory short right now? Like, I could justify it comes back to 04, maybe even 108 even, and then I try going along again on the bounce. But like trying to short it here is probably a suicide mission. They're so close to 16 though that remember 16 was a overnight high from, I believe it was the CPI before the treasuries like really started taking a dive. Beginning of, well, not the beginning, but kind of mid-October. So well, that was the biggest decline or pullback we've had so far this whole thing. Let's see what Reddit r/economics is saying about the number. There's 2 threads. It is a big miss. Are you just logging in? Reminds me, I was messing around with my pen a lot yesterday. Can I... Does it work now? Because I did a little update and it seemed like it fixed things. That's promising. That's promising. Okay, hold on here. Oh yeah. Oh yeah. The quick brown box. I gotta figure out. I gotta get myself holding it right. I'm always changing the way that I'm holding it. And yeah, I want something that's a little bit more, yeah, like that. Still a little iffy, to be honest with you. Okay. The wick round box jumped over the lazy dog. It also does different pressure sensitivities. Liking it. Oh yeah. Oh yeah. Dude, I don't know what they did, but they fixed it. It's still a little bit weird, because I'll still get this lag in the UI. I was a decent pullback now. I don't know, 108 is still kind of like, That's basically like, when I got to the point that it was like, FOMO, what am I gonna do? They've already come back, which is always what happens, and that's why I kind of have learned to just avoid it, right? Okay, well, while I'm thinking about it, I want to talk about this thing with Lucas, okay? Where's let me hold on a second. Because I was talking to him about something, and I couldn't really show him it through chat. Couldn't really show him through chat, and it was kind of frustrating to me. Let's see here. Put it in my downloads spot here first. Yeah, I'll put it right here. Hey, first, last, where you been? Look at the price action. If they are short, then they might be making money. Price ticks down, they unload, then price resumes up. Sort of like selling option for premium. Well, so they market makers probably could have unloaded a lot of it, right? I'm just surprised as a market maker, right? You could end up with like 20K contracts short, and like how is that really going to work out for you? Like, you might be able to make some money, but it's just really risky. In a situation like that, I would expect to see the offers pulling a lot, and to see them like kind of stop providing liquidity in an area, and they didn't really do that. So, anyways. Okay, so here's the study that we was looking at. So they have this equation here. They say the sum of the volume divided by the number of bars is equal to, and then what was this AU2E part? The time frame of analysis, the arrival rate of informed trades, and the arrival rate of uninformed trades. And so then they shift this around, and they come down to this equation, which is, okay, so if you're not, you're a programmer, every time that you see this, right, that is a sum. So what that means is you use a for loop, right? That's how we would write it. Okay. So this means for every bar, add all of the market buys and the market sells. Okay. Oh, actually it's the sell and the buy. Okay, so they actually kind of shifted around. But so this is basically the sell orders minus the buy orders all added together and then divided by the number of bars times the total volume. That's all it is. So it's basically the opposite of cumulative delta divided by number of bars times volume is what it is. So it's like a rolling average cumulative delta is what it is what this indicator is, right? Because what would be cumulative delta? Cumulative delta would be the sum from t equals 1 to n of the V of buying minus the V of selling. See? Kind of an oscillator. I would say it's kind of like a moving average. Oh, sorry. I didn't even give you context on what. So he was pointing out to me a study about VPIN, okay, which is the probability of informed trading, essentially. So it's a measure that some of these quant studies have been using to try and quantify, what is the probability of informed trading, or that there's toxic order flow out there that you don't want to market make against, right? And remember, I've always said that this is kind of like, you don't need this because you have cumulative delta. Well, this is why, because it is cumulative delta. But what it's doing is the difference between this and cumulative delta, if we're to come down here a little bit more, because he talks about both of the other ones. So there's a Lee-Reddy VPIN, which is basically what we do, or what I would write here, right? If we want to make like their indicator. I think that we can make it here in a second if we want, okay? That's where we have the market depth and we look at the best bid and best offer and what price that order went off at to determine whether it was a buy or a sell, right? But a lot of the time, researchers don't have access to that data because, it's getting that level 2, getting that market depth is expensive. And especially getting it like historically is like, I don't know if it actually exists where you can just buy it, right? So they created these other kind of substitutes for it, right? So that is the TR VPIN and the BV VPIN. So the TR VPIN is like a tick rule. So basically they say the volume is buy versus sell based on whether price ticked up or down, essentially. Like they say, okay, here's all this volume, and then if price ticked up, that volume was buy. So, and kind of what they've done is they've said, well, yeah, it's not perfectly accurate. It's not as accurate as Lee-Reddy, but it's accurate enough, and it's faster, and I can do it with different data that, it's worth using this one, or it's worth using this one, right? And so what this study is they're just going through and looking at this BV VPIN, which I think the BV VPIN has to do with, like, they look at how far it moved up and how far it moved down to estimate how much of the volume in that bar was buy versus sell. Okay. So anyways, so what this study is doing is they're doing that and they're saying, oh, it's not bad. Right. Okay, so let us write it. Okay. So they're saying, let's do it. Where is it? Ninja Script Editor. I tell you what, this is super volatile though. Like the speed at which they came back up there is a little frightening to me. Also, we're at 5.452. Oh, and the 30 years is just pushing. That's kind of what's going on there. Wow. In fact, they extended much higher. They went from 24 to 06 on that run. Wow. So that was like 12 ticks out of nowhere. Jeez. Yeah, like Forex. Like you could potentially use those other algorithms to try and get yourself a cumulative delta like indicator in Forex. Possibly. You got so like, well, can you imagine if it had not been a miss? Like on it, if we had another big beat like last time around, this market would have sold so effing hard. Like, this could look so different, right? Oh man, this is a day, man. I'm making the decision right now that I will not trade this. It is too volatile for me to I think be able to make a trade. If I was swinging it, I think that I could swing long equities and probably make money over the next week. But I'm too nervous about getting a good price. Probably the best opportunity for me to get long there was at 08. So let's come and write this indicator, okay? So I have one already that is cumulative delta 2, I think. Where is it? Yeah, cumulative delta 2. I don't know what it just did there, but okay. So let's do LR VPIN. Right? Was that how it was spelt? LR VPIN. Yep. What feeds do you choose? You know what? I don't really pay too much attention to the front page thing. I just listen to the news squawk. I do have like on my news bonds selected in macro. Bonds, macro, risk. Okay, so Fed swaps price first rate cut by June meeting versus July prior. Chance of Fed rate hike by January falls to under 20% after jobs data. Here they go for the 16. Okay. So we're going to copy that code, and we also need this session iterator. And we need the reset delta on, which I think is a property. Oh, actually, we don't need that, actually. Does the news squawk cover whenever Bill? Yeah, actually, they do. Uzi's got. Oh yeah. Oh totally. Wait, where are we at on TLT now? 8704. Or sorry, 8850. I have 8850. Oh, it's saying 8704 because that's where it closed. It's the overnight, but I've got 8854. So that means now 9. That means 140. 1,400. Okay, so I don't know if I need this stuff. Okay, so what I need to do is on calculate on bar close. No. calculate dot on each tick. Can do. Then I'm gonna say if is first oh come on, what is it called? Is first, there we go. Is first tick of bar. I'm gonna shift some things around here. So I think down on this one, I've got like a reset data on. I think that I need actually like a series here. So I need 3 series. 1, 2, 3. And this one will be VPIN. This one will be buys. This one will be sells. Okay. This one I'll say buys of 0. Sells of 0. Equals E dot volume. Days range in Sienna already 4 quarters. Let's look at it from this volatility perspective. It's actually a little bit. It's actually not as big as the 2 days ago one. Can you believe that? It's not as big as the range from the FOMC. Basically, you take the FOMC and then this together is I think that you could get a 100 tick day. I think that the situation, that the amount of volatility that would be justified. And now, will we actually hit that? Who knows if the amount of volume is available out there, but it could do. I am seeing a little bit of a liquidity hole here at 14, so. Okay, and then we need to add plot. Yes, here we go. These plots will be 1, 2, 3. So for that, these two will be. Oh my gosh! Wow! 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 That was such a crazy push, even further. Like, holy crap! Wow. What just happened there was somebody slammed it into 16. And I think that maybe somebody puked, possibly. Okay, buys. Sells. VPIN. We also need a we also need a property to keep track of the time frame. So we're gonna say ninja script property public int period get set. Let me just use auto getters and setters. Okay. And we will say by default, oops, not there, here. Period equals 10. Okay, so if it is the first tick of the bar, then we go and we say for int I equals 1. I is less than I is less than or equal to period I plus plus. And then we say long total equals 0. And we say total equals total plus. And then how did they have it again? Cells minus buys. Cells of 1 minus buys of 1. Okay, and then our indicator will be, oh, we also should say long V total. V total equals V total plus volume. Yeah, volume of 1. Okay. So then we say VPin of 1 equals total divided by V total times period. Think, right? N is period. V is the total volume. And I think I can get rid of all that. Wow, you actually made some money off of that, huh? You traded it? It is insanity, dude. Dollar's not below 105 yet. Silver up 1.84% on the day. Good grief. So this algorithm that I've got right here is like very naive. Is the reason, that's why I'm pausing here. So basically I'm doing this for loop every time. That's not really very efficient, let's say. But oh yeah, I don't need the session iterator. Oh, is this a double? They use a threshold indicator of reaching unsafe levels. Well, that sounds like that they're probably using machine learning to determine what that is, right? But you can use You can just mark that on your chart. Yeah, the delta is bonkers now. It's now 138,000. Jeez. It's still going, too, is like the wild thing. Like, I mean, in all fairness, we should probably get like a trend day today in everything. It's just, I am very not confident in whatever spot I might choose. So that's why I'm gonna sit it out. Kind of stupid for me, but you know, what you gonna do? Oops, I made a mistake. Already found my mistake. Is, oh no, wait, I did not make that mistake. It's just I forgot that the name of it is LR VPN. There it is. Okay, and then we need to change this data series. 2 days and turn on tick replay. No, that is wrong. $20.5 now, man. So, first question, is it actually doing my thing? Doesn't seem like it is. On market data. Oh, I see where I'm making the mistake. 0, 1, 2. Okay. What do you mean, is it based on volume bars? Historically, a dump in rates at the end of a tightening is a pump and dump for stocks. Bend the knee for Jamie Dimon? That is an interesting observation. I think that kind of makes sense. Okay, now you're getting what you're supposed to. So let's switch these ones back to transparent so that they're not affecting it. Not affecting the chart, that is. There you go. And there's your indicator. No, I'm not doing, I'm doing Lee Reddy VPN because it's more accurate. Right? You just realize, again, I'm not sure if you're catching what I'm saying there. The BV VPIN that they're talking about is for when you don't have the market depth to be able to use Lee Ready. Okay, so what does it do is it takes a time period and it takes all of the buys it takes all of the sells minus the buys, and then it divides that by the total volume and the number of bars. The tick, no. It's down over here. VPIN is often applied with one of three trade classification algorithms: tick rule VPIN, BV VPIN, and Lee Ready VPIN. Both TR and BV are level 1 algorithms that use only trade price data. So you use these two when all you have is price. Okay? Lee Ready is a level 2 algorithm that uses both trade and quote data, that's what we just did. It is commonly applied in markets where distinguishing the initiating side of the trade is difficult. Okay. BV is a more time-efficient methodology, whereas TR produces more accurate measures of order balances. Okay, so they're saying TR is more accurate than BV. Okay, but Lee Ready is the most accurate. And there is actually, if I can come back over here, let me find it. Come on. Documents. Trading, learning. No, he did not. I think I would have put it in this best one. Yep, here we go. So here's another paper that's even more recent than the one that you sent me, Lucas. So this one was what? 2018, right? Received November 2017. Okay, so here's one that's even more recent. And they have an algorithm that they say is even more efficient than Lee Ready. And in fact, what they do is that they have a sample of data from the actual NASDAQ, so they can confirm for certain whether an order was a market buy order or a market sell order or whatever the deal is, so that they can verify that their metric was more efficient or more accurate than Lee Ready. And this is used because if I can explain in more detail here, okay, how does Lee Ready work? Okay, it's kind of funny because it's like this complicated paper for something that I think a lot of us traders like intuitively understand, okay? You look at what is the best bid and what is the best offer, and then when you get when you get a new volume in, you say, okay, if we got new volume at 19 is the best offer, so that was a market buy order, right? Okay, well, what if the best bid was 14 and the best offer was 19, and then volume went off at like 17? Then what do you do? And the rule of thumb before, actually, let me re-say that. Let me do it like if it was 16 to 20 and you saw volume at 18, like exactly in the middle of them, essentially, right? Is it a buy or a sell? And it used to be that you'd say, well, if it's above the midpoint, then it's a buy, and if it's below the midpoint, then it was a sell. And If it's on the midpoint, then they split the difference, essentially, right? And what this algorithm discussed in this paper about inferring trade directions in fast markets is they kind of use the tick rule to infer that they use both the tick rule and where it was relative to the midpoint to determine whether it was a buy or a sell. And they found that that was more accurate than Lee Riddy alone in fast markets. So here in the treasuries, where the spread is always 1, this isn't really very significant, because the only place where this becomes inaccurate is because your market depth feed and your volume feed aren't completely synced. Okay. But that algorithm is important in a market where there's like a big spread. And that's why I created a version of that based on this paper. I created a version of cumulative delta using the inferring trade directions in fast markets. And I found that there are some instances where it can be almost a 10% difference. So that's 10% more accurate. Okay, cool. With me so far? So that's what the whole thing is about TR and all of that sort of stuff, right? But the thing that we're getting into here is what are they actually doing, right? So that's where I said again, if I come over here and write, okay, where's my pen? Okay, cumulative delta is equal to the sum from 1 to n of volume of B minus volume of S of T. There's a little T there too, right? Like that. That's cumulative delta. Okay. I could add it. You wouldn't really be able to see it on any instruments that I have on right now. It's just a cumulative delta, so I don't know what it would to show you. Anyways, that's cumulative delta. Okay. So now come down here and look, what are they doing? They're doing sells minus buys. Oh, maybe we need to do absolute value of this. Divided by n times V. Right? So let me come back over here. And just do math.abs of total. Oh, actually, that's the wrong place to put it. This is... You know, it was kind of like, I don't know if this is really actually correct. It's actually... I want math.abs of this. Okay, and let's retry that now. There you go. And probably you should do it as like a percentage or something. I might be making a mistake. I would think that it should turn really high right here. Yeah. There might be a mistake in my code. Let's come back and look again. So I'm adding the totals up. Taking the absolute value of the sells minus the buys. And then adding that to the running total that we have. And taking the total volume. Oh, no, this is so wrong. This is so wrong. Oh my gosh. Okay. I knew there was something. I knew it didn't look quite right. I'm doing of 1 instead of I. Okay. That'll fix it. Then we should get that big spike when we had the news. And we should get a smoother. That's a little bit more like it. Although interesting, this movement right here, that is probably around the London start, isn't it? Although I'm not really getting... I would think that I should get a really big spike in here. But I guess what's happening is... I guess in this instance, what's happening is... This is... Oh, okay. This indicator is representing to you, like, how big is that difference between buys and sells as a percentage of the overall volume is essentially what it's showing you, right? So in this instance, there's so much volume that the difference between the two is actually not that big. An 85 call? Wait, in TLT? Or what I'm not sure I understand what that means. 85 call. 85 call by trader deep in the money. Why would you do that? So you're saying that somebody just bought a bunch of really deep in the money calls? That is weird. What are the numbers to the right? Is just the percentage. So I should probably times it by 001, right? VPIN of 1 actually equals VPIN times 100. And say double temp because it's a percentage, right? Okay, now you get it as a percentage, essentially, right? So 5% is pretty high on this one, apparently. Well, okay. What I'm saying is you can come in here and you can look at what the number is and you can decide what you want to use as your threshold, right? I'm just gonna, sometimes I'm like, not 100% confident about like order of operations. So if I'm doing things right, that change that I just made shouldn't change anything. Yeah. I don't know. I'm still doing something. I think I might still be doing something wrong in here because it seems like it's very much affected by, well, it seems like the amount of volume overall that's coming through matters more to what you're getting. So what's useful about that? Well, okay, so what they're doing is it's called the probability of informed trading. So basically they're saying that this metric is a measure of how much the market makers will want to put at risk on the market. Maybe you made it too smooth? The thing is I would have thought that the change here would be really, really big, right? That's why I'm a little bit like, But the point that I'm trying to make to Lucas here is that you basically already have this kind of information. You've basically always kind of been looking at the market this way. You just, you know, they put a bunch of math in there so you don't necessarily see how that is. Okay, so there was 56,000 sells and 86,000 buys. So that should be, let's see if we're doing this right. $5,600 minus 8,600. It's 3,000. And then you would add all of these other things. It looks like a contrarian indicator. Oh, did I see that the second leg of the meta order came in on time at 8:15 or 7:15? Yeah, I guess you could say that. When was this like pullback though? Was about 30 minutes afterwards. The thing is that this is not a situation where I would be looking for multi-legs of a meta order, right? In this situation, I would expect it to just be hand over fist, everybody trying to grab what they can now sort of a thing. with an occasional ugly pullback. Jeez, look at that stacking and everything. I'll remove it and add it back in. That'll probably be faster. And like, let's use a longer period, like 30-minute period. Oh, you're right. We got PMIs here in a second. I don't know if those are going to be too important, but... Oh, no, it is the services PMI. Okay, how did I miss... Oh, but it's the S&P services. We have ISM services PMI today, huh? ISM services PMI is at the top of the hour. Will be pretty important. Okay, wait. What's going on here? Oh. We found a bug. It's not stopping, man. That's just so wild. I don't know. It does kind of seem to like do some weird things ahead of time is the thing that I'm looking at on there that I think is a little bit odd about it. You see how it's like it's spiking up here, and then when like the real move comes, then the probability of informed trading goes down. I would have expected that when this came through that's when, or sorry, like when this comes through that's when I would see a huge spike. But apparently that's not what happens because there's so much volume that comes through in that time that it cancels it out. That the basically the difference between the buys and sells does get larger, but the ratio between the buys and sells and the total volume actually goes down because the total volume is so much. Yeah, it was supposed to be a predictor. So is this little spike right here the predictor sort of a thing? Maybe. If you think about it, volatile spikes in FOMO time probabilities. Well, yeah, I would expect that what would happen is the probability of informed trading on the news itself would like extend, and then it would very quickly come back down as you're just a noise after that. But that's not the way that it trades. I don't know. I don't know. Every time I looked at this, I came up with... So it is first tick of bars. So what I'm doing here is because it updates on every tick, on each tick, I'm coming back and only doing this calculation where I actually determine the actual total value when a bar ends, essentially. So I'm saying when a bar ends, and then I go and I look at the previous bar and I do the sum. Okay. It's the sum of all of these. Let me come back here. It is the total of the absolute value. Okay, so I get the buys minus sell, or sells minus buys, and the absolute difference of that, and add it to my total. And I also need to get the total volume within those time periods. And then I to take the total divided by the V total times the period, and I times it by 100 and get a percentage. It does not give direction, just that like a move could potentially happen. I do kind of wonder why they do it that way, but I think the reason they do it that way is because if you try to make it directional, informed trading going one way and informed trading going the other way would cancel each other out, even though there is informed trading at that time. So this way, if there's informed trading here and then informed trading right after it, you know, you still get that there's a high amount of informed trading. Oh boy, Feds Barkin is going to be interviewed on CNBC. But at the same time, I feel like that there's a fundamental flaw in this. Because of the way that the volume affects it. Okay. So let me ask you a question. You worked at a big bank and claimed you were once shown what some traders were doing. Did you ever see or been told these professional traders use stop losses? Okay. They had a stop loss. Yes. But their stop loss was like this ridiculous spot. Like the chances of their stop actually getting hit was like it would maybe happen once or twice a year, sort of a thing. Now, keep in mind that these traders were block traders, right? So somebody else has already made the decision they want to buy and sell, and their whole thing is they have to buy it efficiently enough to make money on the difference between what they paid for it and what they actually charged the block trader for, right? So they'll come in and they'll say, okay, the stock is 10 right now. We think that our buying will move it up to 15. So we'll charge you 18. So then they pay 18 for it, and you execute it, and you're right, and it's actually 15, and then you make $3 a share. And that's how they're making money, right? So a stop for them is a little bit different from what a stop for us would be, right? Because we're not, we're the ones actually making the decision. We're more like the hedge fund in this scenario. Well, we're both. We're the hedge fund and the block trader. I don't think people realize how unhealthy the bond market is. This ATR is not good. I would say that liquidity in the bond market, all things considered, is not very good. It's not terrible, but it's not very good. Yeah. Well, that last little spike higher they're giving that up very quickly. So I want to have one other thought about this thing. If I zoom this out, yeah. So like the thing here is that what I'm seeing is that this almost always will spike at this period overnight where it's practically dead, right? So maybe I need to do something so that it only starts on like the regular session or something like that and doesn't continue through sessions. But even then, I don't know if that would actually help. I'm a little bit skeptical about this. What I've got here. I'm skeptical that what I've written is actually this. I'm not convinced that it is actually this, and I'm not convinced that if it's actually as useful of an indicator as these guys in these studies seem to think it is. Can you pull up the cost basis? Oh yeah, sure. Yeah, because we actually are in an interesting spot. You see they came right back to the stop out zone. That's pretty wild. They could come back down to the buyer's cost basis too. That's something that often happens. But it might take a long time for that to happen. So where the average cost basis will be when that happens, it might be like way up here, right? Probably want to go lower. Well, I don't think so, because basically there's one parameter, which is the period that you're looking at, and that's going to change between instruments, right? The one thing that you could do is you can turn it into a heat map. So what you do is you say the lowest row is period 1, period 2, 3, 4, 5, 6, 7, 8, you know, up to whatever number you're willing to go to. And then each pixel you color according to how high the indicator is. And then you get a heat map of how the indicator is reacting on different time frames. Have you considered using edge clears ladders? Are you talking about Edge Pro X? Yeah, well, look, almost all of these other platforms have like other columns other than the current buys and sells, you know? Whether or not those columns actually tell you something useful, that remains to be proven. None of them really quantify the thing that I'm spending most of my effort trying to see, right? So can we discuss that for a second? What do I mean by that? So you can see the resting liquidity. Oh, they're pulling for the news, by the way. ISM services, they're looking for reading of 56.6. Okay. Anyways, there's the resting liquidity. I can see that, but that's not all of the liquidity that's there. And there's latent liquidity underneath. And these guys, they don't want to make their intentions clear. So they don't put their liquidity out there until like just as it gets filled. So that's why you get things like icebergs and things like that. So you might say, well, so you could use volume profile as a measure of past liquidity. Well, yes and no, because volume profile will show it to you for the whole session. And so it doesn't really show you that, okay, we was in this area and we moved away from it, came back, and then we were in this area again. And how much liquidity was taken this first time versus this second time and that sort of a thing. And, and that could even be like it ticked up and then it ticked back down. And what's the liquidity, right? Like every one of those things kind of matters. So that's why I'm looking at it like every time it ticks, how many contracts did it take it to trade? Makes sense? That's why I look at that. That's one of the primary things that I'm looking to try and judge what the current liquidity is. Let's minimize these windows here so that we can see what the yields go to here. We're at 4.5 right now. Okay, so ISM services PMI 51.8. So it is still in expansion, but much lower than the forecast of 53. And prices paid was still higher than anticipated. So you're still getting kind of stagflationary data, suggesting that overall activity and employment and so forth is slowing, but that prices are still going up. So even though the market spiked up on that one, I don't think that number is actually that good for bonds. I think that an argument could be made that even though we're heading for a slowdown, we could be headed for a slowdown where the Federal Reserve just can't reduce rates. That if the Federal Reserve, that we're still getting inflation even though we're in a recession. Which would be like really ugly, right? Anyways, I feel like I spent a lot of time on that VPIN thing. Do you have any other questions about that, Lucas, or do you understand what it's doing now? And why I was saying like, oh, it's actually really cool. I was just trying to, the thing that I thought was so interesting about it was that here was a study that was doing something that you already do in your head, especially if you're doing like the Gary Norton stuffs, right? Because what is one of the things that Gary Norton says is he says, okay, like how much volume is actually trading right now and how much is on the bid, right? Like if I'm 1,000 in line, then how long is it taking right now for 1,000 buy orders to actually come through? How long are you going to be sitting there waiting for it, right? And you basically have to be able to know, like there's enough activity in this situation to actually get your fill on both sides, and to know when the amount of market orders coming through are much more than the liquidity, and that you need to have a little bit wider of a spread. Seems I have to go back at just looking at the ladders. Well, yeah. I mean, I think that the usefulness of a study like this is it's quantifying something that you already do, right? So what is it kind of saying to us? Is it saying that you can look at the balance between market buy and market sell orders and how big that imbalance is compared to the absolute amount of volume trading to get a possibly predictive signal that you can kind of tell when there's somebody out there buying something up, which we do that with the volume profile. But it's also kind of like in order for it to really be a very good trade for us, we have to have a really good idea of what that thing may actually be, why they may actually be buying it. So that's why I feel like our innovation is still, you need to be informed, or informed is the biggest edge, is the way that I would put it. And being informed is the biggest edge, right? It's kind of interesting because I feel like that we've done a couple of things that kind of take some of this stuff a little further, right? Basically, I have some ideas. We've done some stuff that some of these researchers might find interesting, right? So, because what are the innovations that we've added on top of that? So we also care about, is the change in the orders and the change in the price correlated or not? And only trade when it's correlated? And how consistent is the imbalance between the buys and the sells? That's another metric that appears to matter. Okay, so there was like the big spike up on the news, and then we traded considerably lower. Now we're reverting back up, so we're getting a little bit of fight here in the treasuries. Dude. If the treasuries turned around and said that because of that services number that we still think that it's higher for longer, basically, that the services cancels out the boost in interest rates from the non-farms, that would really throw an extra wrench, because here you got everybody buying everything hand over fist, and then the treasuries come and crash the party. It's a little bit of like we said, the liquidity is a little bit weak, so that does kind of make them vulnerable to that sort of a thing, doesn't it? Anyways, another thing, Lucas, I just want to point out is that now you can go back and read that study and understand a lot more about what they're talking about and what the math is, right? Because a lot of this is like, because these studies are based off of other studies, you know, kind of building knowledge upon knowledge. So now you're going to go back and read some of this other stuff. So it's going to make a lot more sense. There's some other models. Like, actually, I haven't shown you this. You've read the Trades, Quotes, and Prices book, right? I have that on. I have a PDF version of it. I mean, I own the book, but I have a PDF version of it as well. Let me see here. I don't want to cover things up. I'm going to close these windows now. I have to go through that one. I really need to better understand the microstructure of the market. I already went through who my competitors were, which I think is more. Okay, so like in this book, when you start to get later on, optimal scheduling, I think that's a little bit further back than that. Actually, let me come back up here. So basically what they do is they come in here and they're like, okay, here's how the financial market works. Okay. Here's like, you know, the basics of like, oh, is there an efficient market or not? And then we start getting into models about limit order books, empirical properties, okay, models, joint queue dynamics for large tick, Santa Fe model, clustering and correlations. So this is talking about how orders are kind of cluster, and so you use a Hawk's process for that. That's one. Right? Is how do you deal with the fact that it's like, okay, I know that on average there's X orders per second, but it's not actually X orders. It's like they kind of come in clumps. And how do you deal with that? That's what that's all about. So that's actually really, really useful information that we should probably do a little bit more study on. Okay, and then price impact, meta orders, Kyle model. So this is adverse selection and liquidity provision. Okay, so then they come into the Kyle model. Okay, if the Kyle model is, how do I adjust for the probability that somebody out there actually knows what's going on? Okay, so that's what that one is about. And then the question is, how do you determine what your bid-ask spread actually should be based off of that? But then this one right here, chapter 319. 319 is the first one where I think it's like really useful. I think there's another one over here. Oh, no, maybe it is this one. Because basically what happens... No, it's not like... Well, I don't know. Basically what happens here is they come down to, well, okay, so based off of everything that we know about that, then how is it that market making can actually be profitable, right? And so then they come into this model where they basically show you, they basically prove where the profits from market making come from. Right? So you'd be really interested in that. The Kyle criterion, well, no, so we've talked about this before, but what the Kyle model is basically it says, okay, I know for certain, because I'm a time traveler, that at exactly an hour from now, that something is going to happen that tells everybody that the correct price for the 10-year treasury is actually 109 even. Okay, like some piece of breaking news that the rest of the market doesn't have yet that says, yeah, actually we should be at 109 even. Or that like the exchange is going to say we're going to set it to 109 even at exactly this time. Right? So then the question is, if I have an infinite amount of money, how much do I buy to maximize my profits? Because if my orders have impact and I buy, and then we actually come all the way up to 109.06, I pushed the market too far, then when that piece of news comes out, we're going to get snapped back down to here, right? So basically, I spent money on a bunch of orders that actually had a negative impact on things, essentially, right? And so the whole question is like, what would be that optimal number, essentially, if I was at the quote informed trader? Now that number turns out to be like the majority of the volume. Okay. So you probably wouldn't want to use that exact number because the market would clue in on something very, very quickly. Okay. But it's kind of like a theoretical basis that you can use to say, this is how much opportunity is in the market. Like if I know where it's going to go, this is how big I can actually trade, right? The more volatility and the more volume there is in the market, the larger you can potentially trade in those situations, right? And then the reason they're doing all of that is they turn around and they take it from the market maker's position and they say, okay, at what point do you as a market maker have a really good chance of knowing that somebody is out there is doing that there's an inside trader doing something, and I need to adjust the amount of inventory that I'm taking on and what my best bid and offer are to account for that, right? Which is exactly the thing that you're talking about, right? That's the Kyle model. Now there's deficiencies in the Kyle model, and that's kind of the cool thing is you go down through it, and it's just kind of like one piece building on another piece. So there's the Kyle model, and then we find out, oh, actually, the impact of meta orders follows the square root law. So that actually kind of changes what you'd want, what prices you'd want to use. Have you upgraded to Windows 11 yet? Not yet. I need to. So I think that what will happen is when I build the new machine here, like probably after Black Friday, then I will upgrade to Windows 11. I am using Windows 11 on my work laptop, though. And I know that the feature... So my work laptop is using the preview of Windows 11. So I know that the feature I need is in the preview. I don't know if they've pushed it out to everybody yet. I guess I could look that up. Windows 11 combine taskbar. What feature? Okay, so the feature that I'm waiting on is if you come into Windows 10 and you right click on the taskbar and you go to taskbar settings and you come in here and there's this question over here which says combine taskbar buttons. So what this does is it says if I have 20 jigsaw windows open, they will all be represented by one window. Right? If I tell it always and hide labels, see how I only get like, oh, actually you can't see that. Let's see here. Okay, now you can see down at the bottom. Okay, so do you see how down at the bottom of my taskbar, there's only like 5 icons? Right? So if I want to get to a specific chart or make a specific window pop up, I have to click here first, and then I have to pick which one of them it is, right? Whereas if I change this to never combine, then they all get split out, right? So Windows 11 does not have that property. There are like things you can download that kind of janky downloads, but they do give it to you. But for some reason, they decided that was not going to be a feature of Windows 11, that we want to force you to use this other system. And that basically makes it that one thing is enough that like if you're really doing productivity stuff, it completely kills you. It's not usable. So that's why that's the big thing I've been waiting for on Windows 11. And it is coming. Okay, H23H2. Windows 11. Oh, it is now available. Okay. So apparently you can get it now. 23H2. Cool. So I could switch to Windows 11 right now if I wanted to, but I will probably keep this machine alone until I build a new machine, and I'll just go to Windows 11 when I do that. What about speed? Well, I doubt that it makes it significant. My understanding is that there are enough performance increases in Windows 11 to justify moving over to it. Yeah. In fact, I want to do it because I think that it will solve a couple of the issues because sometimes I would get into this thing where it's like if I try and do stuff that's using memory, like opening new tabs, for instance, and that sometimes I get this slowness that's like just really, really effing annoying. So you know what? Having watched this now, let's look at it from the chart. So here was the initial news, and then I usually wait 5 to 15 minutes afterwards. I guess if I had done it right in the first few minutes, I could have gotten 04. Okay. But if I waited until 15 minutes afterwards, basically you're getting '08. Okay. So I could have bought '08, held this and been like, oh, this is awesome. Maybe held it too long and seen all of that come back. So during all of this, I was feeling like extreme FOMO. Like, I don't know if you could tell, but I decided to just dive head deep into a programming thing I normally would not do on a Friday, but I felt like I needed to distract myself because I knew that the temptation to trade this was too great and that the volatility and risk to me wasn't worth it. Now that we've seen that all of those gains that they had have been given back, kind of makes me feel really good about the decision to not trade it, doesn't it? But of course, that has a lot to do with those services prices being higher than anticipated. And you can kind of see, I don't know how much of this is actually like a sell meta order, like trying to cancel it out yet. Don't have a whole lot of evidence of that. Wild day. So let's come back over here and check around the market. So I still want to see the... Okay. So here's Reddit's comments on the jobs report. October's jobs report, U.S. economy adds 150,000 jobs in October, 150,000 new jobs, but multiple job holders increased by 205,000. Was October a win or a loss? And August and September got revised down 62 and 39. With these revisions, employment in August and September is 101,000 combined, lower than previously reported. Stock market surge this week is suggesting the Fed is now done with their hikes. In fact, a pause the Fed has now done for 2 consecutive meetings is being interpreted by bond and equity markets as a pre-cut. Hard to be thrilled. Is an American labor and consumer with the idea that somehow new jobs and people moving towards being employed in more than one job is a positive thing. Numbers suggest a soft landing is possible. I don't know. It wasn't that much worse than reality. I mean, I feel like that. I'm gonna write my comment. At this point, non-farms is basically a joke. The numbers that we get on the initial report are nowhere close. Every report gets huge swings between reports. Going from 300K jobs 1 month to 150K the next. It's not even, the report tells us almost nothing. This report is no longer the valuable view on the economy it used to be, and market participants should stop giving it so much weight. Okay, now let's come back to Zero Hedge and see their little, like, kind of dissecting it. I'll read this one on the services sector. Weak jobs growth and easing wage growth, just the kind of bad news that markets love, and sure enough, stocks and bonds are soaring as the dollar dives on dovishly driving rate change expectations. As Capital Economics points out, the strongest argument for the Fed to abandon its tightening basis is that wage growth continues to slow, with average hourly earnings rising by a muted 0.2 month on month and the annual growth rate falling to 4.1%, the lowest since mid-2021. The decline in the job quits rate continues to suggest it will drop below 4% soon. Overall, we suspect the softening in labor market conditions has much further to run and still expect the Fed to be cutting interest rates again in the first half of next year. Rate cuts are coming. Gregory Farinello, head of U.S. rates trading and strategy for Amerivet Securities, says the employment report fits our view that the economy is slowing, and in the wake of this week's dovish Fed meeting and presser, adds, it's clear why Chair Jay Powell stood confident this week. That is a perfect number for a stock rally. Indeed, it was, lifting small caps in NASDAQ to weekly gains of 6%. Additionally, John Brady at RJ O'Brien calls payrolls a bond-friendly number. Don't think the AHE numbers will be much of a concern. Bad news, clearly softening labor market is market good news. And he is right, yields have collapsed in the long and short end. 30-year yields are down, 2-year yields are down 25 basis points from Wednesday's highs. The 2-year move is stunning, said Steve Sosnick of Interactive Brokers. It's a big move across the curve, but 14 basis points on the short end is enormous. WIRP now showing a cut by June instead of July. Modest payrolls and wage growth could imply that Goldilocks is really coming. Too early to say after one report, but for today, it's exactly what bond bulls wanted to hear. Barry Knapp of Ironsides Research says this report is, for sure, a turning point for bond bulls. Equity markets, on the other hand, need the Fed to fully pivot, he said. Dollar puked, extending its weekly decline. Hira Misra, portfolio manager at JP Morgan Investment Management, says the market is responding as you expect on the weaker than consensus payrolls, downward revisions, and wages. Gold initially spiked on the headlines as the dollar gives, with spot prices topping 2,000, but then it was curb stomped back down again. It's been all over the place. I'm looking at it right now. They are below 2,000. Oh man, you think that they'll hold it or not? This is a very, very curious one. Ali Jaffrey, an economist at CIBC Capital Markets, has this take. Weighing down the headline job number was a 33,000 decline in motor vehicle and parts employment as a result of the UAW strike, which should mostly reverse next month. Overall, even abstracting from the UAW strike, today's report suggests labor demand has been a bit cooler than the data was telling us in September, and labor supply stalled at least momentarily. So, it's bad news, which is just good enough for the algos to bid everything higher. Meanwhile, the underemployment rate, or U6, climbed up to 7.2%, the highest since February 2022. This is a broader measure of unemployment that tracks the unemployed as well as those marginally attached to the labor force and part-time for economic reasons. Are we really celebrating a 2-year high in white unemployment? Well, I mean, really what it comes down to is that women don't see the need to work. Okay, cool. Maybe as we dig through the details, we will find something strong in this report, but it seems weak across the board. Jobs, only 150K is bad enough, comes with 101 of negative revisions. Why do we torture all those economists who made predictions that looked wrong at the time of the release because their estimates were too low, only to find out 2 months later they were probably right? Private sector was below 100K, and manufacturing lost a significant number of jobs despite reshoring, etc. Hourly earnings were lower, in line with some other estimates yesterday of declining wage pressure despite the high-profile union deals. The unemployment rate ticked up to 3.9, while the participation rate declined a touch. Exactly the response you do not want to see. Fewer people are trying to work, and the unemployment and underemployment rates nudged higher. This was because the household survey was a miserable job loss of 348K, making net job losses over the past 3 months. Hours worked, which hasn't really supported the strength in the prior reports, inched down as well, not signaling that this could be a one-time glitch. I know that weather cannot be an excuse this time. The strikes could have had an impact, but I find it difficult to believe the impact is so big to drag down the entirety of this report. While the margin for both reports is obscenely high relative to how they are presented, I'm starting to wonder if the household doesn't reflect reality better, since it asks potential employees, not employers. The one argument I've heard that I like is that if someone is laid off but receiving severance pay, the company reports them as employed, but the employee views himself as unemployed. To save you time on the link, the margin of error to be statistically significant is 130 for the establishment and 600 for the household. I wonder if, with the lower response rates for the establishment, the margin for error there isn't even larger. In any case, why don't we just get the raw data and let anyone who wants to use an AI or other algos to do all the adjustments? Maybe we'll get some interesting data that way. I should feel that the same way. Since I mentioned response rates, the current employment survey statistics response rate was 32.5 for the July survey. That was 67% as recently as December 2019. Tyler Durden is like being way casual in talking about this. Like he's like saying this is my personal opinion, and he's talking about it in like the first person. I'm starting to wonder. That's unusual for him to speak that way. Sorry if I got a bit wonky at the end, but garbage in, garbage out is one of the tenets that I live by in this data. Between the margin for error issues and the response rate seems fraught with garbage, despite being one of the biggest data days for the market every month. Exactly. I don't think that the market should give this number as much, attention as we do, because the number just seems to not actually tell us anything about reality at all. Okay, well, as I'm discussing this, we did come back to the buyer's cost basis. So now we have really, truly washed out all of the gains since the initial spike. And are we going to start going into the single prints starting at 0.0 half? Well, that's still quite a ways away. Oh, it's a 0.1, a 0 still. That's quite a ways away. Dum, ba-dum, ba-dum, ba-dum. Oh. And Crypto Trader Advisor, yeah. Do I not have? No, I do. There's somebody joined the server named Roaring Kitty. I highly doubt that that's actually the real Roaring Kitty, though. It's probably somebody spamming, too. Seems like my algorithm missed a person, but I don't know. How did that happen? Too many screens? It might seem like that if you're not familiar with the DOM, but there's actually not as much going on here as you might think. It's just we're keeping track of multiple instruments, right? Because this is the 5-year, the 10-year, and the 30-year. So like, kind of look at all of this together. And then these are all just the interest rates as well. So it's kind of, again, 30, 10, 5, and 2. So it's actually a little bit easier to wrap your head around than you might think, because they're all kind of doing the same thing, right? I'm just kind of noting the slight differences between them, right? Like that the 5-year ticked down 2 ticks there, as opposed to the 10 years 1 tick down. So I know that the yield curve is flattening back out after this services number. Okay, services. After weak manufacturing surveys for October, the services sector surveys are forecasted to be mixed, with PMI expected higher and ISM services to decline, but both are... Wait, is this one... The ISM survey shows prices paid considerably hotter than expected and employment notably worse than expected. Manufacturers and service providers saw a quick rise in output despite fragile demand conditions. Aggregate new orders continued to decrease as service sector demand waned. Says Chris Williamson, the PMI survey paints a far more subdued picture of U.S. economic health than the last bumper GDP numbers, with October seeing a very muted growth of business activity for a third successive month. A summer surge in service sector activity fueled by rising consumer spending has stalled. Manufacturing is meanwhile also struggling to regain momentum amid weak global demand. As such, the survey data is broadly consistent with GDP rising at an annual rate of around 1.5%. There is a silver lining, though. An upside to the weak demand environment is a further cooling of price pressures in October, which brings the Fed's 2% target into focus for the first time in 3 years. Brighter outlook for inflation and hopes of a commensurate peaking in interest rates have helped lift business confidence in year-ahead prospects, but new business inflows need to pick up in both services as well as manufacturing to ensure robust growth can be sustained and we head towards the end of the year. Finally, we note that the recent dramatic tightening of financial conditions may be about to still the jam out of the economy's donut. Of course, as the last few days shows, the excitement about the Fed hinting it's done is actually easing financial conditions, prompting a reflexive vicious cycle that will bring back a hawkish Fed, and around we go. Yeah. You know, like, what does this tell us about the path forward till, let's say, like, till next March? Is, you know, I think that this still becomes very fraught. I'm seeing the market say, like, everything's good, soft landing, buy all of the things. I'm not so sure about that. Like, because this is kind of suggests that that we're weakening the economy, but that we're going to have to keep keep interest rates where they are. And that by the time the Federal Reserve is like, oh, okay, now we can reduce interest rates, like, the economy will have already cratered. That's on one side of it. And then there's also this issue where I do see, so they were saying that inflation came down. Well, it did come down, but, like, so if you come here, where is it? Prices paid. So the previous reading was 58.9, and this reading was 58.6. So yes, it did come down, but the market estimate was 56.6. So it was much higher than the market estimate. In other words, inflation is coming down, but it's being more sticky than everybody anticipates. And that could be a real stumbling block that could prevent the Federal Reserve from starting to reduce interest rates as quickly as the market might. So now the market is saying in June, okay. I have a hard time seeing the market continue to perform like this and people actually get paid for the risk that they're taking on, 3 to 6 months into the future, and then, having to reduce interest rates in June. Don't see it happening. Because, like, seems like everybody wants to come in and buy it. Okay. Is there anything else? Is Bidenomics winning bankruptcies spike as consumer confidence falls to 5-month lows? Well, I won't read that one. That seems more like an opinion piece. Seems like it was Tyler's opinion, though. He's not quoting somebody else. We are coming back up. So we're like in full-blown trading now. Like, it's kind of a crapshoot for me now. Oh, there should be an interesting thread. Reddit, what did you buy that made you so much happier? It looks like a short squeeze rather than value buying. Oh, I'm not so sure about that because I think that earlier on, like Wednesday was kind of like the short squeezing. If you are still short at this point and puking, then like I guess you deserve it. But I do think that like the impetus for this though was people betting that the interest rate cycle is over and that now is the place where you can buy stocks. It's just, I am still skeptical of this whole, like, the Federal Reserve can reduce interest rates without there being like a real recession. Like, we're seeing the economy weaken, and it's kind of like they're all saying, oh, well, it will kind of continue to just, you know, weaken slowly, and then we can reduce interest rates 1 or 2 times and then we'll be stable. And I'm just not buying that, you know? So I think the move today makes sense and is in line with everything, but I'm still very concerned about like the next 3 to 6 months out. And of course, the amount that the treasuries have moved this week is pretty insane. And I did not take advantage of hardly any of it. It was like it got too wild for me, I guess. I'm sure we'll get some good opportunities, but right now when it's doing these sorts of things are not necessarily, you know, that's really good for like swing trading and not necessarily for us scalping. What did you buy that made you so much happier? My own apartment. Okay, good. I'm expecting to see some technology device that I want to go and buy now. Come on. Piano, LASIK, a bed. Okay. You know what? You suck, Reddit. This is like the most boring. Man, this is just like the most boring answers that come up to the top now. Fed can reduce rate because of the break-in correlation between oil and gasoline prices. Oil went up, gas. Well, I don't know. I think that there are things driving inflation other than just energy prices. Like you've got all of these people that are basically their real income is down, right? So if the stock market comes roaring back and we're at all-time highs all of a sudden again, you don't think those people are going to demand more money for their labor? Right? It's just everybody's basically just sitting here waiting for the opportunity to buy. So as soon as they get it, you just look at it this week, right? Everybody's waiting for the opportunity to buy, and when it happens, you get this, and it just spikes up like 5% in a week. It's wild. And you're telling me that this is going to continue to go on, like it's going to be an uptrend for the next like 6 months, and that you're not going to get inflation at some point, right? Something about that scenario doesn't fit. I think that the flows that we're seeing are make sense. Flows that we're seeing make sense, but like from a long-term perspective, you know, because like I'm not sure, I have a little bit saved that I haven't put into a stock, mostly because I haven't picked a stock that I think is really, really good. This is not making me want to dip my toes in. It was kind of like what you were saying with JP Morgan earlier, that like this kind of like we're done and we're pausing can kind of become a pump and dump thing for stocks, as they say, oh yay, lower interest rates, this is good, buy all of the things, and then it's only a few months later when they're like, oh man, like the economy really is going in the dumpster now, this is going to affect company earnings, and you know everything starts selling off now. You know, that happens. So, you know, like if I go back to 2008, you know, they were done with the cycle before it peaked, you know? So, I also want to add that today's range is actually not as wild as some other days. I guess we got to 90 ticks today, so that's pretty in line with some of the bigger ones in the treasuries. Not as big as March earlier this year during the whole banking crisis thing. It brings us basically it brings us to the 50-day moving average, and we're actually coming right back to it. It'd be funny if we just ended at 108 even again today. Yes. That's kind of what I'm saying, is that right now there's demand inflation that's kind of latent. That it's out there and they're just waiting for the thing to come up and to start demanding again. And so I think that demand inflation could come back very, very quickly. And the scenario that the market seems to be painting is a scenario where I think that demand of inflation would come back very strongly. You know, I was saying I don't feel like Twitter has changed that much. But I actually am noticing now, like, I'm not spending as much time reading the tweets. So I think that Twitter activity has declined and is not as good as it was. CTA shorts bonds are getting crushed nonstop. Sitting ducks here, probably. mean, really, if we had just been short the market, short interest rates like starting from last week or whenever it was, we'd be up like $500 now just from a swing on that. So. But again, for us today, it's just incredibly curious that basically the spot that was available to me, if I had held it the whole time, we would be back at break even. I don't think I would have held it the whole time. I don't know if I would have caught a good exit either, though. Probably would have only caught a small winner. When did Bill Gross say that? Regional bank falling knife is hit bottom. I'm buying TFC, GFC key. I don't know if I'm as interested in. So the issue I have with the regional banks is that kind of the problems that they have, like the unrealized losses and stuff that they have, is something that's likely to be around for a really long time. Like the bounce that we've gotten here is, if you caught that, then great. But I don't know if that's the one that I want to hold for like 5 years, Like you could probably get an okay gain on it, but I'm not sure if it's going to be the best performer. I have a question about cumulative delta. Okay. Sometimes when correlation breaks between price and cumulative delta, the price will lead, and sometimes the cumulative delta will lead to equilibrium. Why is that? Which lead is stronger or more important? Yeah, so if I understand your question correctly here, what you're saying is if I have price is moving up and then keeps going up, and I have cumulative deltas moving up and then it starts going down, then what's going to happen is price going to move down and catch up to the cumulative delta falling? Or is price going to continue moving up and cumulative delta will revert back up? Right? Now, how do you know which one? Because basically what you're saying right? The price will lead, and sometimes the cumulative delta will lead to equilibrium. There's basically the only two options. In order for cumulative delta and price to come back into correlation with each other, one of those two things happens. Which one is it, and what does it matter? I don't know. I've done a lot of study to try and determine when you get a divergence in cumulative delta, can you predict which way it's going to go? Can you predict which thing it's going to happen? And all of my research suggests that it's a crapshoot. That like a lot of people will try and make a prediction about it, and a lot of people are trying to trade off of that divergence, but that it doesn't predict very well what the market is going to do. So, what would matter, I think, is why is it happening? I think why is it happening is very, very important, right? Is it happening because there is hedging activity going on right now? You see there's a lag right now? How much of a lag is there? That makes us sad. I have dropped a few frames today. Yeah. But anyways, you know, so I've basically like, you know, it happens. When it happens, I just stay away. Oh, well, there should only be like a 5-second lag. The lag should only be 5 seconds though. I'm practicing my writing. Writing with a tablet is really hard. I have very good lines out here, yeah. Still a bit smaller. Yes, it's minor, but you're toting a scout 5 seconds is too long. Oh man, did you hear one of my toddlers throwing a temper tantrum out there? Good grief. I really like that this pen works so well now, and I can do like these sorts of things. Like, let's make like the... Like it's a meteor shower. Oh no, it's the dinosaurs are gonna die. I was wondering what that noise was. Ethan just went, dude, he has like the highest pitched shrill scream. It's just really annoying. And he's kind of gotten to this age where he understands what's going on and on those sorts of things. And so it's just like this shrieking all the time. It's so annoying. I feel like with this nib that I don't have very good control. I need like a felt nib or something like that. I'm able to hold it pretty good, like, so that it's have a relaxed hand, because I've always in the past held it in ways that actually makes it really strained. Stop it, Seth has gastrointestinal. I've been muting the stream for that. You know what else though? I'm messing with this. I'm kind of like, maybe using the pen for placing orders is actually not a bad way to do it. Oh. I think I need to use this. That's interesting. Right click should kill it. There you go. And using this button should do the right click, right? There we go. There we go. Yeah, the right click is a little janky on this one, I think. But the pen thing, the whole pen thing is working really. Now, I wonder if it works well with, there's this new feature that like, oh, come on. Huh. Come on. Okay, now it's doing it. But it is, that's interesting. It does seem, that does seem to slow it down a little bit. So they'll need to fix that. What helps missing these moves for me is each Sunday night I review the week ahead and pick my volatility spots. I mean, I think just as of recent, I don't think that I'll always be trading like this, but just as of recent, when like the super insane volatility comes in, I've kind of been hands off, because I've basically had some periods where like it did pretty okay like most days, and then these big days will come in and I get screwed somehow. So basically what I'm learning is that there's a certain point at which the volatility becomes so big that the noise out there is larger than my edge, and so I have to trade those situations a little bit differently. Ta-da! And now I can do things like underline stuff. I can do like a little underline. Then I can do like a big underline. Yeah, that looks stupid. I should do it with the highlighter. There we go. So another interesting thing I can do with the pen here is, oh, it doesn't accept that kind of. For me to scroll, I have to use the mouse. Oh, you know what? Maybe it was because I had because I was still using the highlighter. Ah, there we go. It's a little too sensitive. It's a little way too sensitive for that. Something that this does that I think is really great though with the pen that I wish I could do with my regular mouse. So explain this to me. How come you can't do this with your regular mouse? If I come over in here in my web browser and I just like click and drag, it scrolls, and I can even kind of like throw it like that. How come I can't do that with a mouse? Because that's a way better scroll. Like my poor little finger get tired from all this scrolling I do all day, you know? I've been taught on markets with more volatility, trade less size and grab size moves, and in low volatility straits, increase size with smaller. Yeah. I have a lot of active time in the game. I'm not sure what you're trying to say, Octavius. But Octavius says accounts were blown this week. Probably. 90 calls for June? Oh boy, oh my. I find it really curious that like as soon as this gets crazy, right? Like everybody starts piling on the options trades. Right? But like, well, I guess they're doing okay right now in TLT. The TLT, they're at 88.72. The 30-year seems to be, so we're getting like flattening coming in again, so that's kind of what's that's. I don't know. I guess the thing I have a problem with today is that, like, to me, it's always like, you're going to have an expansion or a contraction. And so this kind of like a Goldilocks scenario where like the economy declines just enough that like we're in a fair zone, and then we can just kind of, you know, move along like that, and everything's, I'm not convinced that that's going to happen. I'm not convinced that that can happen. I think that there's too much reflexivity in it, that as soon as the weakness in the economy starts to become apparent to the market, that the market will collapse very quickly. But the market doesn't see it that way right now. So we'll see what ends up happening. I think that next week, I think that we don't get CPI until the week afterwards. So next week should be some kind of interesting and varied trade. I'm a little bit more hands-off in the fourth quarter anyways. It's really good for equities, but for bonds, it's kind of like iffy, right? I try and do most of my trading between January and March. That's when I should be the most active, so. Yep. Wild day. Wild day. Non-farms miss Spark's massive rally is today's title. Anyways, guys, I feel like I've kind of become really disjointed in last year. I don't know even what I'm talking about, but we'll be back on Monday. So I'll see you guys then. In the meantime, stay excellent, team.